Today's video, we are going to learn the fundamentals of options trading with some real world examples, looking at screenshots from the Robinhood brokerage on buying and selling option contracts with both calls and puts, and understand at the baseline level what an option is and how do you trade them. So, what are options? Options are contracts giving you the right, not the obligation, to buy or sell an asset at a set price by expiration. So, a key point here is one contract controls 100 shares. And so you're leveraged. So, if you buy one contract of Apple, for example, you're controlling 100 shares. So, you have quite a bit of leverage in both directions. You can make quite a bit more and you can also lose quite a bit. So, you need to understand what you're doing when you start options trading. Some key terminology: the strike price is the price you buy or sell your contract at. The premium is the cost of the contract. You can collect premium and you can pay premium for a specific contract. Expiration is just when the contract expires. And then you have in the money, out of the money, and at the money, which basically comes with when you're talking about the strike price. So, getting into some of the actual examples of buying versus selling, calls and puts, let's dive in. So, when you're buying a call option, you have the right to buy 100 shares. You have to pay a premium up front. You profit if the price is greater than the strike price you selected plus the premium that you paid to buy the contract. And your max loss is simply the premium that you may have paid for that contract. Whereas the profit is theoretically unlimited if the stock goes up to incredible levels. If it goes up 500%, 1,000%, right? You will continue to profit if it continues to rise within that expiration period. So to explain this a little bit more, I have a couple pictures that I screenshotted, and I just have it open in Microsoft Paint in case we want to circle some things or whatever we may need to do here. So this is an example in Robinhood. We can see that the Hood stock, Robinhood stock, is currently trading at $41.11. Okay, so we are in the screen to buy a call option, which we just talked about, that expires in about 5 days. Okay, so this is a very short term uh, call option contract. And you can see here that we have a lot of different asking prices for these different contracts. So we can obviously see here, just like above, that the current price of Hood is trading at $41.11. And we can either go below the current share price or above the current share price. Okay, so if we are going to buy an options contract below the current trading price, this is going to be in the money. Okay, because we are buying a contract that is less than the current price. If we were to go and buy a contract above the current share price, that would be out of the money. And so you can see that in a contract where you're buying, if you go in the money, you're going to be paying a little bit more for that premium as you go deeper down because you have a greater chance of making money off of the option, right? You can see here that if you bought the $40 strike price, the stock just has to go up simply 3% for you to profit. Whereas if you bought something out of the money, let's say this $43 strike price for $83 instead of $229, the stock has to go up about 6.5% for you to break even. Okay. So, all things to consider when you're buying a call option. And again, if you are buying it in the money here, you are going to pay this premium is $1.71 times 100, right? Because these are options. You're controlling 100 shares of a stock. And so you're going to pay $171 per contract of Robinhood. And you're basically hoping that in the next 5 days, the stock is going to shoot up, right? The stock is going to go up past here, and you'll be able to collect a good amount of money along the way. Maybe we're expecting some good news. Maybe the stock has hit a bottom and you think it's going to shoot back up. Okay. So that is buying a call option. And really quick, I have just another picture of this, which is the expected profit and loss, a P&L graph. Just showing this really quick. So this is, again, where the max profit when you're buying a call option is theoretically unlimited, right? Because if the stock went up to $1,000, you would be making quite a bit of money, right? And the max loss is going to be the premium that you paid. So it really depends on, what option you decided to buy. But in this case, right, we bought the $1.71 option, this one right here. And so we're going to pay $171. And so what this means, right, just to hone this in, if the stock goes all the way down to say, $40, $30, etc., if it keeps dropping low, you're going to hit that max loss and you're going to lose $171 per contract. Um, if the stock lands somewhere in between here, you're not going to lose the entire premium that you paid, but you're going to lose quite a bit unless it hits that break even. Okay. Now, note you could always sell options early. We can talk about all that in a different video, but just know that that is a possibility. All right, now let's talk about selling a call option. And so when you're selling a call option, you have the obligation to sell 100 shares. You receive a premium upfront. So again, this is very different than paying a premium, right? You're receiving a premium. And the profit is the premium that you get paid plus any capital gains that you actually will get from selling the stock. And so, when you're thinking about options, you're really just talking about this premium, but it's good to mention the capital gains as well, because that is additional income that you're going to make off of the stock or ETF itself from the price going up. So if we go back to Paint here, let's open up another example that I have over here. Just one second. Yeah, right here. Let's open up the covered call. Okay, so it's right here. So you can see, again, we're going to be looking at Hood, same price, took these very like close together, right? So all the prices should be the exact same. But you can see here now, instead of buying, we are selling a call option, same expiration date, just for the sake of the example, right? And you can see here, when we're looking at our options chain, we are going to sell a call option that is out of the money, right? Because it is higher than the stock price when we're looking at call options. And so you can see here that if we were to sell this call option at $43, we would basically make $80 off of that trade. Now, this is to say that you have to own 100 shares of Robinhood before you would make this covered call. The reason is, if you didn't own those 100 shares of Hood before you do this option contract, it would be what's called a naked call. Uh, and a lot of brokerages, I don't even think will let you do that. I know Robinhood specifically won't for anything that I've ever done, at least. Maybe there's a special option that I've never heard of. But as far as I'm aware, you can't do naked calls. And so you have to own 100 shares of the stock. And so let's say you own Hood at $41 and you sell this covered call at $43 and you make $80 off of that. Okay, so basically what that means is that if the stock by the end of the week is anywhere between this range, less than $43 and literally, well, greater than whatever, right? It just has to be less than $43. Ideally, not less than the price that you paid for it, right? But as long as the price of Robinhood is below $43, you will not have to sell your shares. You will simply just collect that $80 in premium and the option will expire worthless. Okay, that's very important to understand. If the option expires worthless, meaning that the price of the stock is below your strike price of your option contract, it'll expire worthless and you'll just collect that premium and you're ready to do this again next week, next month, whatever you decide to do. On the contrary, if the stock goes above $43 by April 25th, you are then obligated to sell Hood. However, the part of options that includes quite a bit of risk, right, is if the stock blows past $43, and let's just say for sake of example, it just goes to $44, then you're not selling Robinhood at $44. You're selling it at $43 because that is what that's what you're obligated to do when you buy this contract. Okay? And so that means that your capital gains is going to be 43 minus 41. Okay? So you'll make, what is that? A couple $100, right? Off of the capital gains because again, every contract is leveraging 100 shares. So you'll collect that $200 plus $80. So you'll make $280 off of that total trade. Now you could have made an extra $100, right? If you wouldn't have done this options contract, but you got paid $80. So really you only missed out on $20. But again, you're risking this chance that the stock isn't going to go above that strike price. Okay. So if we look at the P&L graph, okay, maybe this will help make this even more clear, where the stock is currently trading at $41, right? You have your covered call at, what did we say, $43. And so as long as the stock stays below $43 in this green zone and anything lower, you're going to hit that max profit on that premium. Now, if the stock goes obviously far above, you are potentially missing out on money. But if you bought the stock at a lower price than it's currently trading, or even at the price that it's currently trading, you're still going to make money. Okay. And let's not pay attention to some of these other fields right now. We could talk about it in a different video. All right, so that's call options. Hopefully that makes sense. Again, we can have some further videos to go even more in depth, but at the high level, that is what happens when you're buying a call option and when you're selling a call option. Finally, let's talk about puts, and let's briefly talk about buying a put option and selling a put option. So if we start with buying a put option, we have the right to sell 100 shares. We pay a premium upfront. The profit is if the price is less than the strike price minus the premium, which we'll look at the diagram or the screenshot, and hopefully this will make more sense. And then the max loss is just the premium. So similar to what we have for the calls, when you're buying a call option, when you're buying a put option, you have the max loss is that premium as well. So if we jump into Paint here, we can open up, let's see, buying a put option. Let's not save this right here. So all this stuff is the exact same, right? So we'll skim past all this, but we're buying, in this case, a put option instead of a call option. And again, same expiration for sake of example. Yeah, we can go through this much quicker, right? So we've already talked about all of this. We know what the share price is, and we are now buying a put option, right? If you're buying a put or you're trying to short a stock or an ETF, you're assuming that the price is going to go down, right? And so in this case, this is in the money, and this is out of the money. Okay, this can be a little bit confusing at first because it is opposite from a call option. Okay, so when you're buying a put option, anything that is essentially greater than the current share price is in the money. Vice versa, anything that is less than the share price is out of the money, right? It's the same logic as when you're buying a call option, but it's reversed because you're expecting the stock to go down. Okay. And so we could talk about these different prices, but again, it's the same thing, right? So the further out of the money you go, the more you're going to pay because the stock has to drop a higher percentage than if you are in the money, the stock doesn't have to drop as much for you to break even. Okay? The option chain is really here to help you. It's really your friend. I would say spend a lot of time with the options chain. Open this up and look at the Greeks, which we'll cover in another video, and just really look at everything, the different strike prices, the breakdown, what's the percentage that you need to break even, percentage change, and the asking prices, and it'll really start making sense. And look through, obviously all of the when you're buying calls, buying puts, selling, etc. And this will start to click. Okay, so instead of spending more time on that, let's just go ahead and pull up the P&L graph. Okay. So this is, again, if we were to buy this $41.50 put option for $171. Oh, whoops, wrong one. You can see here that the max profit is basically if that stock were to go basically to zero, right? But your max loss is if the stock goes up, right? Because if the stock price goes up above $41.50, then you're going to hit that max loss and you're going to lose that entire premium that you paid. Okay. And you can see that your break even is here at $39.79. So if the stock is trading anywhere between $39.79 and $41.50, you're not going to lose everything, but you're still going to lose on the trade. Okay. So it's cool to see like this expected P&L right now, because this might look scary when you're initially trying to buy the put option, because you might be looking at this like, oh, my expected loss is $132. That doesn't make any sense. Uh, it's just because of where the stock price is, right? Because there's a lot going on behind the scenes of like expiration and data decay and everything like that. Again, future video conversations. But what you need to know for the basics is that this is the expected P&L if the stock does not move at all. Okay. But again, if you're shorting the stock, you're expecting that there's some bad news or the stock has hit an all-time high or something like that, where the stock price is going to go down into this green zone where you're going to actually start making some money. Okay. So that is buying a put option. Now let's talk about selling a put option or a cash secured put. So in this case, you have the obligation to buy 100 shares of a stock or ETF, and you receive a premium up front. The profit in this case is that premium that you receive, and the risk is the strike minus the premium. Okay, so we'll talk about what that means. Let's jump over to Paint, and let's just open the example up. If we sell a put option, all right, here we go. All of this is the same as we have been talking about the entire video, but now we are selling a put option, okay? Same expiration. And you can see that we have selected a options contract that is out of the money, okay? This is out of the money because we are selling a put option that is lower than the current share price. Okay, so what this means at a high level is the stock is trading at $41. We are going to sell this put contract saying that if the stock drops from $41 to 40 or below, we will buy 100 shares of Robinhood at $40. And with doing so, we will collect $1.02, or again, you have to times this by 100, so $102. Okay? So the reason why this is really cool is, let's say that the stock goes up in these next 5 days, right? Say that we've hit some sort of floor, we have a bunch of great news, etc., and we think the stock is going to go up. Now, this is a great opportunity to sell put options or cash secured puts, because you are hopefully going to just collect this premium. The option will expire worthless because the stock price is again above your strike price, and you'll just keep that premium and you are good to go for the next week, month, whatever you want to do. Now, some of the caveats here are you do have to put up a lot more capital when you are selling a cash secured put. Okay, you can also do naked puts. Again, I don't believe Robinhood lets us do that, so let's not talk about it. And again, that's more of an advanced technique, anyways. And so in this case, we have to assume that we have $4,000 in our trading account to be able to sell this contract. Okay, and let me head over to this diagram really quick right here, just to make sure that this makes sense, right? So again, our max profit here is capped at the premium that we collect, just $102 for selling this put option. However, the max loss could be really, $3,800 and $3,900 in this case, which is what It is the premium or the current price that you bought, like this guy right here, right? $40 minus the premium that you would collect, $102. If the stock were to go to absolutely zero. Okay. So if the stock were to go to zero, it would be, $4,000 minus the $102 that you collected. Now, this is here for your guidance, but really like we would never expect a stock to go to zero if we're buying or selling options, right? We want to be option trading on good fundamental stocks, blue chip stocks, stocks that we really believe in. For example, Robinhood for me. Like I love the company, I love where they're going. Their balance sheet looks good. The CEO is incredible, and they're doing a lot of innovative things in the space, right? So it'd be really crazy to think that Robinhood could go to zero, but you do have to take that into consideration. Okay. Um, and then just one more thing about selling put options. This is a great way to collect weekly or monthly premium. You could make upwards of 5-10% a month just selling put options, right? Depending on the stocks, depending on your level of risk, where you buy your strike prices, etc. We can make a bunch of cool videos in the future talking about the wheel strategy and basically what goes into it. The first part being selling these cash secured puts. Okay. And again, I think we covered it, but just to touch on it one more time, if the stock goes below $40, we have to buy the shares at $40 per share. Okay, so let's say we hit a another stock market crash or we go into a more of a recession, the stock drops 20-30%, whatever it may be, and let's say the stock is now trading at $30 per share when this contract expires. Well, that means that we lost $1,000, right? Because we got paid $100 to buy the stock at $40 per share, and now the stock is $30 per share, and we still have to buy it at $40. So really, it's actually not $1,000 that we lost; it's $1,000 minus $102. Okay, so we technically had to spend $898 more dollars for the stock because it dropped in those 5 days. So again, there's always risks with options trading. Okay, the safest type of options trading would be when you're selling call options and selling put options, right? Because you're basically delaying a purchase of a stock and getting paid to do it in a company that you already believe in, fundamentals look good, and you want to own the stock anyways. I cannot own that. I cannot say that enough times. You would want to only sell put options or cash secured puts on stocks that you want to own because if the stock does pull back, you will be obligated to buy those shares. Okay. And then you could go ahead and sell a call option to sell those shares at a higher price, collect a premium, and whatever capital gains that you actually had. Okay. So selling option contracts is a little bit safer than buying option contracts because of the loss of like you're going to be capped at the premium that you paid, which is great. But these premiums are typically quite expensive, right, for some of these really big companies. And so the odds of losing everything, hopefully aren't high because you've done your research, you're doing it, you're buying or selling, or sorry, you're buying a call or put option on a good company. You expect that it's going to go up, the stock price is going to go up or go down, but still, you need to be cautious because you can lose that entire premium. All right, with that being said, we're going to wrap up the video there. Probably a lot longer than it needed to be. But again, just wanted to go over the fundamentals of buying and selling option contracts, calls, puts. What are they? When do you do them? And just understanding them a little bit more. If you open up Robinhood and you click on options and you're going through the options chain, hopefully now some of what you see makes sense. All right, we'll catch you in the next one where we'll go even deeper on options trading.